Private equity firms now control $8.2 trillion in assets, more than the GDP of every country on Earth except the US and China. They've used it to buy 1 in 5 American hospitals, hundreds of thousands of homes, and the paychecks of 12 million workers. And wherever they land, 3 things happen. Rents rise, patients die, and jobs vanish. This isn't investing, it's strip mining, and the data proves it. Let's start with the squeeze you feel every month. Since 2008, when the Fed flooded the world with cheap money, private equity went on the biggest buying spree in economic history. Homes, hospitals, vet clinics, trailer parks, dental chains, nursing homes. And look what happened to consumer prices in the countries where PE is most aggressive. The U.S. inflation curve doesn't just track other rich economies, it accelerates past them after 2020, right as PE's residential portfolio hit an all-time high. Sweden and Japan, which restrict institutional landlords, stay flat. The correlation isn't a coincidence. When one firm owns 50,000 houses in a metro area, they set the price. When they own 40% of the emergency rooms in a state, they set the bill. Cheap capital didn't lower costs for you. It gave PE the ammo to raise them. Here's the counter-argument you'll hear from every PE apologist on CNBC. Private equity brings efficiency. They cut waste. They save struggling hospitals. Beautiful theory. Now look at the data. U.S. health spending per capita has more than tripled since 2000, blowing past every peer country. Germany, France, Sweden, all with universal systems and no PE ownership of hospitals, spend half what we do. If PE were making healthcare efficient, U.S. costs should be falling relative to peers. They're exploding. A JAMA study found patient falls jump 27% and infections rise 38% after PE buys a hospital. Medicare patients are 10% more likely to die within 30 days. This isn't efficiency, it's extraction. They load hospitals with debt, sell the land, fire the nurses, and cash out before the bodies pile up. It gets worse. While costs skyrocket, capacity collapses. Hospital beds per 1,000 people in the U.S. have been in freefall for 2 decades, down to 2.8, well below Germany's 7.8 and Japan's 12.6. When PE buys a hospital, the playbook is public. Close the maternity ward, shut the ER, sell the real estate to a REIT, and lease it back at brutal rates. Steward Healthcare, owned by Cerberus, bankrupted 30 hospitals across 8 states in 2024. Cerberus walked away with $800 million in profit. Rural America lost its emergency rooms. This is the pattern. PE doesn't add capacity. It liquidates it. Every closed maternity ward, every 90-minute ambulance ride to the next town, that's the price of someone else's IRR. Now the jobs. PE portfolio companies employ 12 million Americans, more than manufacturing, and they don't create jobs, they erase them. Research from the University of Chicago found employment at PE-acquired public companies drops 13% within 2 years. But something weirder happens, too. Self-employment rises. Because when PE fires you, restructures your department, or outsources your job, you become a contractor. You're not building a business. You're a gig worker without benefits. Look at the U.S. line versus Germany and France, where labor laws block this kind of restructuring. Their self-employment trends stay stable. The U.S. shows the churn of a workforce being systematically converted from employees to expendable contractors. So where does all the money go? Straight up. The US Gini coefficient, the single best measure of inequality, has climbed to 41.3, the highest of any wealthy democracy. Germany sits at 32, France at 32, Sweden at 30. The U.S. isn't a rich country anymore. It's a rich country's asset portfolio, and 90% of us live inside it as tenants, patients, and workers. The top 0.1% now owns more wealth than the bottom 50% combined. That's not capitalism working. That's a financial Hoover pointed at every American household. And the nozzle has a name: private equity. Private equity isn't investing in America. It's dismantling it for parts. The data is unambiguous. Wherever PE buys in, rents rise, patients die, jobs disappear, and inequality widens. This isn't a market failure. It's the market working exactly as designed for the 3,000 people who run these funds. Blackstone, KKR, Apollo, Cerberus, they don't build hospitals. They don't build homes. They buy what Americans already built, load it with debt, extract the cash, and leave the wreckage for the rest of us. Until Congress closes the carried interest loophole and bans PE ownership of essential services, this pattern won't slow down. It will accelerate, because the returns are too good for them. If you want the data other channels won't show you, subscribe. No opinions, no vibes, just charts that name names. New investigations every week.